Welcome to the MHP Exchange, where the riches are in the niches. We'll show you how to invest your way into mobile home parks with real strategies, tips, and behind-the-scenes know-how to grow your cash flow. Stick around. This is where smart investing begins.
Our guest today didn't just build a portfolio, he built a machine. Mario Dattilo started his first business in high school. He scaled to over 1,500 salespeople, and then he crashed hard. He rebuilt from the ground up, and today he's vertically integrated his real estate operation. He controls over 1,000 mobile home sites. He's got multiple self-storage assets, and he's across 6 states. He's done over 30 off-market commercial acquisitions. And the best part about it is he is not a slave to his own portfolio. And in this conversation, we're going to unpack the exact KPIs, the value add playbook, and the capital allocation strategies that have kept him scaling in one of the most competitive markets in history. This isn't another how to buy a mobile home park episode. This is an inside look at a top 1% operator and how he scales in 2025 without burning out and without losing control. With all that, Mario Dattilo, welcome to the program.
Fireworks. All those that whole intro makes me feel important. Thank you. Yeah. Thanks for having me, Frank. I love what you're doing with the show and excited to be here and just hang out and talk shop. You know, it's funny because a lot of times when you're in the grind and building the business and day to day dealing with, the business, to be able to like stop and just go hang out and talk shop high level is fun. So yeah, thanks.
Yeah, listen, I appreciate you being on. That's the best part about doing this is when you speak to other operators and people like yourself who have been in the business for such a long time and have, a different vantage point of what it takes to scale. I mean, you're in 6 states across multiple.
7. That bio is delayed.
Okay. 7, right? And multiple asset classes. So what's the KPI dashboard that you look at every single Monday to set your week right and to know what's working and what's not?
Yeah, I mean, every week I meet with my leadership team and we go through all the key metrics that you'd want to know were working. Things like collection balances, sales, homes work in progress. Things like how many reports were done on time based on the deadlines for our investor reporting. Just kind of thinking construction projects, CapEx projects, on track, off track. Kind of just thinking down the spreadsheet off the top of my head. But really what I want 1 to 3 key numbers for each department that tells me, is it healthy or is it hurting, right? So operationally, the property management folks, they're looking at occupancy, collections, things like that. And that's probably where I gravitate the most because I want to make sure the money's coming in because obviously on the back end, we got to pay bills, but every piece matters. And there's not a single person on our team that doesn't have at least 1 to 2 KPIs that they're reporting on. And that goes from me, all the way down to, a community manager or a maintenance person. And by down, I don't mean that they're lower. It just means that throughout the organization, everybody's reporting up those numbers that tell a story. And we can quickly gauge if there's a problem coming up based on one of those numbers being off.
So you hit on something there. It's about assigning a number that everybody takes ownership of, right? Throughout the organization, which I think is so key. And I think a lot of people lose fact of that. So whether you're doing the groundskeeping or you're managing the property, I mean, there should be something that person takes ownership of because that's going to be healthy for you, right? That's healthy for the entire organization. But is there one number, one KPI that if you woke up Monday morning and you saw it was down 10%, is that the one that you'd be most concerned about?
Yes, collection balances. If for some reason we have a very high collection balance, I would be concerned. Thankfully, we're targeting 3% or below. And, what's great is that we line up the numbers week over week. And so we can quickly see if we're on track from last month or where we're at compared to a month over month schedule. And I would say collections are number one. Sales is important because without sales, unless you're doing a lot of leasing, your occupancy is going to be low. So it's kind of a machine, right? I mean, you look at it from you've got your daily collections, eviction counts, all that kind of stuff. But you also have this separate machine, which is occupancy. And that means the evictions to the abandoned titles, to the renovations, and then to the ultimate marketing and sale of the home on the back end of the portfolio or the pipeline. So you can kind of have the daily collections with your performing lots going smoothly. But if you're lagging or hurting, which I'll be very transparent, that's where we have hurt the most, is on that getting the unit made ready and resold on the back end. That can really hurt you. So I mean, is there one metric? Yeah, it's probably collections, right? Because I want to make sure the money's coming in the front door. But ultimately, there are metrics that can kill you. Small metrics in some cases that if you don't watch them closely, it hurts. I would say that a lot of times people getting into this business, they look at it as investing in real estate. This is not a real estate investment. This is a business that you and I are in, and that anybody who goes out and buys a property that actually has to run it, they have to look at this more as an operating business than just a real estate investment, because that's what it is.
So that is such a key point. And one of the things that we try to drill in when we talk to people about the mobile home park space, it is not, you're buying real estate, but you're buying real estate that has a business attached to it. And with that, and these parks, there's so many different things that you could get lost in. It's about being focused on the one thing that week that's going to move the needle the most. And I find that that's the conversation that I constantly have with different team members. Like, all right, that's nice, but is it the most important thing? I mean, do you find that with your team? Is that a conversation?
Yeah, absolutely. I have a meeting with a group meeting on Tuesdays at 10 a.m. And then on Thursdays, I meet with some of the leadership one-on-one. And that's where I try and figure out how I can remove roadblocks. I can figure out where they're having challenges. I make sure that their focus is on the main thing, which may change week to week, kind of like what you're saying. I mean, in some situations, we might have a property where a bunch of homes are showing up. Well, I need to make sure my construction manager's focus is on that project that week. Or we may have a leak issue at a specific property that's costing us a bunch of money. I need to make sure that he's focused on that. But each person's metrics are going to speak to their performance in general. I would say that I'm not a micromanager. I've found very good people that manage their departments well, but they can get distracted easily, especially because, for example, a construction manager might be getting a phone call from somebody at a community manager or something like that, about a project. And that can sometimes pull their focus away from what I feel is going to move the needle the most. So yeah, I mean, I meet with them. I meet with leadership one-on-one, and then I meet with leadership as a group. We talk about different things in each one of those meetings. But if you're looking to buy mobile home parks and just make an investment and pay a management company, you will fail. If you set it up like an operating business with those metrics that need to be tracked, and you're thinking about the people who are running it, not as just remote controlled people on site for you, but actually thinking, managing professionals, you'll get much better results that way.
And with that, I mean, you're vertically integrated. You self-manage all your assets, right? So
not all of them, actually. We bought, for about 10 years, we managed everything internally. Okay. Then in 2024, we went to third-party management with the assets that we managed. We took it back about 16 months later. It took back at least some of the communities internally about 16 months later. We do manage a good amount ourselves, but then we do have JV partners that manage their own stuff. And we own self-storage, industrial, and RV parks. We don't manage any of those, just mobile home parks.
Just mobile home parks.
But we don't manage all of our mobile home parks either. We do have JV partners that have their own property management teams that manage some of those as well.
Okay, so let's pulling that aside, right?
Very mixed bag.
Yeah, no, and I get it, because sometimes you're gonna co-invest with somebody. Maybe it's an area or market where they've got a bigger footprint, but
Sure.
in the communities that you own, and you've got that organizational setup, for those out there that want to scale that business, like, how did you layer out your organization to do that? Right? Is it, you have an operating officer, like chief operating officer, do all the property managers report to you? I mean, how did you structure, Mario Dattilo's mobile home park, enterprise?
Yeah, I've got directors of different divisions. So like I've got a director of property management. She runs the entire property management arm. Managers, operations coordinator. Operations coordinator is kind of like a support person, I guess you could say. Regionals all report to her. I've got a director of asset management, which basically she just handles all of the ownership responsibilities. So that's tax negotiations, that's investor related kind of, I don't want to say issues, but technical questions that need to go to get answered, budget approvals, just anything that's ownership related that's kind of above and beyond just property management. She approves CapEx stuff. She handles CapEx budgets, business plans, all of that. I've got a director of construction. He manages all the construction related stuff. I've got a director of investor relations that handles the investor relations piece, raises the capital, manages the relationships with the investors ongoing. Director of acquisitions, he handles an acquisitions team, and each one of those directors report to me then.
Okay. So I heard you on another podcast, and you said something that, I mean, in its essence is so simple and makes so much sense, but I think so many people take the other approach. And you were talking about a hire that you made, right? Where you went above the pay grade to get this person, because you had gone the other way. And people don't, I think a lot of times where entrepreneurs make a mistake, they look at how much is that person going to cost me, right? Sure. But you took it the other approach where you're like, well, how much is that person going to do for me? You elaborated it much better. So if you want to kind of share that, because I think as you're talking about scaling the organization, that's a point that people really need to understand.
Yeah, I think I'll start with saying how I screwed up. And I think that I think I know what you're referring to. We originally started our business and kind of followed the model of we're going to have greeters at these communities. And that's a pretty well-known term in the industry. And that's where you've got somebody at the property level that basically just is a remote control person, right? It's kind of, I was mentioning before, they do exactly what you tell them to do. Their job is to not think and just greet people as they come in and make sure people don't have a violation or, just very minor things. And the problem with that business model is they're not trained to think. They don't think. They just do exactly what they're told to do. And what does that create? A major loop, right? You're going to have all these questions coming back to you from an offsite management standpoint, and it creates a bigger workload for you offsite. So probably 3 years into it, we've been doing this like 13 years now. Probably 3-4 years into it, I figured out, I'm like, if I just hire people that have certain skills and also have the ability to be resourceful, that's one of our core values, is be resourceful, and they can actually make decisions, we're not going to need as much management staff offsite. Like, I actually save money by having higher quality people on the ground that are trained, and we invest into them to then I don't need as much offsite, which is the real expensive investment, right? Your on-site managers are don't get me wrong, it's an expensive investment, but your offsite, your leadership, that's expensive. So we just kind of shifted our mindset from a greeter, remote control person to recruiting people that have the skills and the resourcefulness, and also in many cases, the background or track record in the industry where they can come into the company and tell us how we should be improving. Now, community managers, I'm not saying our community managers come in with a lot of experience, but our offsite team, yeah, it's been an investment. You know, you hire someone from a larger company that's managed a lot larger portfolio than yours in their specific expertise, and they come in and go, well, yeah, at this other company, we did it this way. They can really help you solve the problems, because what we found is that early on, when I would hire somebody that was a low cost employee, I had to train them on everything. But being 3-4 years in, you really don't know that much, and you don't know how much you don't know. So really, by recruiting people that have to be taught everything, you're always going to limit your growth because you don't know everything, and especially in the beginning. So you're kind of teaching someone to do things in a way that an entry level entrepreneur knows.
No.
So by recruiting the higher level person, they come in and go, yeah, we need to change all this, and you can grow much faster. It costs you money, but it saves you time.
And that is such a important point. I mean, for us, very similar. We happen to believe that your community manager, I mean, they're so critical. They are your brand ambassador down on the ground. And we acquired a community 2 years ago, and I mean, there was literally no income there when we started. So the manager we got, seasoned, Class B apartments, came in. I mean, the rent being collected was basically paying her salary. So we were losing money because of that. Yet 2 years later, we're ahead of where we anticipated to be in our underwrite. We've gotten new homes onboarded, homes sold, and she is essentially, even though we're with a back end support, she reports to us, she knows what the business plan is. She's on autopilot most of the time and can make 80% of the decisions without coming back to us, right? Like, so she's able to do that. It saves us time, and we're able to focus on other items that could add some additional value. So having the right person and paying that is so critical to success. And somebody
It's hard though. It's hard though. In the beginning, it's really hard because you don't have a lot of revenue to cover those. So it's like easy to say, and I'm saying it's easy for me to be like, yeah, just hire up, overspend on people. Yeah. In the beginning, when you're just getting started, you got 2-3 parks. It's like, I can't float this person's salary. So there's a weird balancing act that you've got to play. It's like, how much am I willing to invest to get to grow faster, to then be able to afford the people? You actually have to recruit in advance and pay more than you can in the beginning.
You know what? I think it's a mindset. And I think what happened with me, right? Specifically, I have a friend of mine who's successful in another business. And when we having this conversation with him previously, he was like, you're looking at it, what you have to pay them for the year.
Yeah.
Look at it. What is that investment you're going to make over the next 90 days, right? Because in that 90 days, they should create that value for you where the rest of their salary is being paid. So if you look at it in a 90-day window, a 3-month window, you'll say, oh, I'm willing to make that, I can make a $15,000 investment for 90 days, and I'll see how that works out. If it doesn't work, I could always fall back to the cheaper option.
Sure.
But more times than not, if you have the right person, it'll just accelerate your growth. You're not going to want to go backwards. So
agreed. Well, on top of that too, if you stop and you look at the high level of what you're trying to accomplish and the overall valuation of the big picture, you start to look and go, I'm trying to cut $7,000, $8,000, $10,000 from a salary, but the big picture on what they're going to create, it's not even a discussion. Like, you wouldn't, if you think about what it's going to create 5 years from now, that $10,000 over 5 years, that $50K that you spend over 5 years or 10 years is just, it's not even a discussion.
So when you talk about the value they're going to create, and this is a great segue into this, like, you consider yourself a value add investor. I mean, you're not buying, are you buying? What's your typical
Yeah,
you know,
everything's
buy.
value add. We're
Yeah.
typically buying stuff that doesn't have really low physical occupancy. Like we're not buying half empty parks, and I wouldn't consider us a big infill operator. We're buying things that have more operational improvements, CapEx, all that kind of stuff. But generally speaking, 50 or more occupied lots, 75% physically occupied or more. And yeah, major metros. We are definitely value add investors. So that's kind of what I'm talking about is when you're recruiting somebody who's going to help you take a property and make millions on it. What's the extra $5,000 a $10,000 a year? It's just not even on the radar.
So, what is your typical value add playbook, right? It's not just, hey, the rents are low, I'm going to move it to market. Like, where do you look to add value to the residents, to the resident experience in terms of operationally? What are you looking at a community when you're dissecting a deal? Where do you find that you can really create some value that maybe other people don't see?
Yeah, I mean, it kind of goes back to where we're at in this market cycle and where we're at with consolidation in this industry. We have a lot of these owners that have basically let these communities go because it was a lifestyle business for them, right? They own them free and clear. They live on the income, and they kind of have this silent agreement with the tenants. I won't raise my rents, but don't expect me to fix anything, right? And so what happens then? It just goes downhill over a long period of time to where now you see these communities and they look dilapidated and run down, and the tenant base is not attractive in the sense of they can't afford living anywhere else. And so what we do is we look at that community and say, okay, yes, it's a 50-year-old property. Yes, it's never going to be a beautiful property. But what can we do with some cash infusion and better operations to make it the best that it can possibly be for these residents? And by doing that, we can then obviously bring rents to market over time and command a better tenant base, a better resident community of people that are going to pay us, right? So it's kind of like we're going to flip the script and say, hey, we're going to make this as nice of a community as it can be based on what we're working with. And in return, we expect you to pay rent on time, and we expect you to pay market rent to help us pay the staff and the money needed to make those improvements. So it's kind of flipping that agreement upside down and more like flipping it upside right to make it the best that it can possibly be. And what I mean by that is I'm not going to be able to take a community that has 1980s homes and replace all the homes. Like you can't change that, but you can change the roads, all the infrastructure. You can change signage. You can do landscaping. You can make sure that when a tenant calls and has an issue, somebody answers the phone and solves the problem for them and treats them like a customer versus just a headache that they have to deal with to get their rent, right? So it's giving them a professional experience as, a customer service relationship and making the capital improvements that probably haven't been done, or even the deferred maintenance that hasn't been done in years at most of these communities to bring them up to market.
Yeah, and that's a great point, because some of the things that we'll look at, especially if you're buying a park that you're going to have some older homes in there. I mean, that's just going to be part and parcel. You have a early 90s home. You might have a great resident, but their home might be a little tired, right? So, we can go in there. We can offer the power wash, we can skirt, we could do their decking, we can cool seal their roof. And in exchange of us doing that, they're typically, if they don't have the capital to do that, they don't mind getting a rent bump because they've received some value, right? And if you're buying it right and you're going in there with the intention is I'm going to offer a little of that, I'm going to already underwrite that I'm going to invest a little capital into homes I don't own, but I'm going to protect the integrity of their home. Then it's easier to get guiding that rent to market. And it also, like, as an additional win, if I do have to do infill there, it's easier for me now to bring in a new home and get somebody to say, hey, I could live next to a house that's been updated. So I think by adding that to that mix, now you're really enhancing the resident experience. We find that there's less pushback in
Yeah.
terms of, hey, this is what it takes to run. I'd love to keep rents at 1985 prices, but I'm not paying. I can't pay a 1985 salary. Like I have
Sure.
to get, to your point earlier, I have to get people
1985
professional.
taxes or insurance or all.
Insurance is a huge thing.
Landscaping. Yeah. Yeah. Being honest, we don't really do much to the resident owned homes. From time to time, but I can't say that we've went in, bought a community and then said, we're going to replace skirting on 20 homes that we don't own, or replace steps on 20 homes that we don't own. Maybe we should. But we typically go in, make improvements to the community owned homes and the infrastructure and the roads and all that. And then we follow through with enforcing the rules and pushing people to make their own improvements. Do we, from time to time fix things for people? Sure. But I can't say that we've went in and done major improvements on resident owned homes before. So it's interesting that you said that you guys are doing that.
Yeah. We just found that if we do that exterior, and I think for us, we found that it worked because we brought in new homes to one community, and then we realized, hey, this market, they should sell. They're not selling because people are going outside. And I'm real estate licensed. I sold real estate for a number of years. You could have a brand new home. You go outside. If your neighbor's home is a mess or a junk collector or whatever the case is, you're gonna have a tough time selling that home unless you're So if we just made the neighbor's house look a little bit nicer, it becomes a win-win-win situation. Yeah. They don't mind the rent increase. They're getting value. The park gets additional value, and we're able to sell homes and, get that person to pay market rent because they're in a better looking community.
Sure.
Now,
yeah, it makes total sense. I mean, yeah, just haven't done that, but I like that. Yep.
So I know you mentioned that you just entered your 7th state. Was that did you just go into Texas? Was that it?
South Carolina.
North Carolina?
South.
Oh, South. Okay. Yeah. So is that a deal you want to just talk about, like how you looked at that deal? What was your vantage point on, why that ticked the box for you?
Yeah, I would say that deal is actually a joint venture deal. I'm not doing the day-to-day operations. We closed on a deal right before that. That is a community in Texas, in Houston. If you want to talk Texas, that's an 80-site community. Call it 74 homes sitting on lots. A couple of sites need to be developed to get to the full 80. And it's in Houston Metro. Lot rents significantly below market. I'm talking like $365 in lot rent in Houston, which lot rents there are $650 to $700 in many cases. And a really good example of a community that was let go. A lot of potholes in the roads. They're busted up. There's even the community lights were broken. The mailboxes were looking really rough. I'm just kind of thinking of all the CapEx of signage was horrible. Tons of overgrown trees. You could just tell that it wasn't being managed, but the location was solid, backed up to a school. Houston's kind of quirky because there's no zoning in the majority of Houston, or a lot of Houston. But so it's a little bit hodgepodge of what's on that street, but very dense location. And there was just mismanagement. So what we did is we bought the community, and we're a couple months into this, so relatively early on, but we're going to redo all the roads. So we're going to resurface all the roads. We're developing 2 sites. We've got homes coming in. We've got all the landscaping has been cleaned up. We took down a lot of trees. We're putting in new street lights. That's something that we really like to do on the communities where either the lights are pretty old and dingy or they're just not there. We'll go in and put in really nice solar lights, decorative. We've kind of we've been starting to find ways to not just go ahead. What?
Yeah, people don't realize when you mention the lights, like how important that is.
Yes.
So what it does, not only does it light up the community, it's also a great safety measure for people,
sure.
Right? Because at that point, you might not be able to eliminate every bad issue that happens, but typically people don't like doing that in the light. So, I mean, it's a low cost, high impact improvement. And that that is a value add for residents who are there, especially if they're in a community that's been run down, like to have lighting, to add that added level of security. I didn't mean to cut you off on the rest of you talking, but that's a big value add that not a lot of people talk about.
Not a lot of people do it because a lot of them probably don't drive through their parks at night, but at the same time, it's something that it does, it's a safety thing and it looks good. We used to just put in the most basic pole, basic post, basic light on top, looked kind of industrial. And now we're starting to do more decorative lighting, decorative signage, things like that, to where we decided that if we're going to replace something that looked either super rinky dink and old and basic, what is the difference between putting an extra 5% or 8% into the cost of that light or that sign or those ballards or whatever it is in the big picture? If we're going to be bringing in homes, or even if we're not, to up the look of the community just a little bit for an extra 5 to 8% cost increase, it's worth it. Because when it comes to bringing rents to market and making sure that we're getting every dollar that the market can bear, people want to live in a place that looks nice. I don't care if you live in a mobile home or if you live in a high-end home. Everybody wants to go home to a community that they're proud to live in. And those little features go a long way. And that 5% difference could be the difference between $1,000 light post and $1,075 light post. And now you've got some decorative features to it. And so we've just started doing that more and more on anything that we're doing. My construction manager gets really annoyed because he's like, all right, this is what we've been doing for a very long time. He knows now to bring it to me and say, here's a couple different options. Do we want to make that larger investment for the aesthetic look? And we're doing that. So,
and I think that's great you're doing it, because there is a pride of ownership. I mean, if you want to be we're running, we talk about, I know everybody calls them parks or trailer parks and mobile home parks, but I think the shift is, hey, I'm buying a trailer park, I'm converting it into a manufactured housing community. And if you want to have people treat it that way, then the operator has to treat it that way. And those little touches mean so much, because your resident isn't going to have more pride in ownership than you are, right? And if you raise that bar and elevate those standards, you'll give the residents something to shoot for, right? And they might go past you, but if you set that bar low, then most of your residents are going to keep it there. So it's great that you're thinking about that and not just, hey, let me find the lowest cost option and move on to the next thing.
Because what you end up doing is you just continue the trailer park look of the community. And I'm not saying we go build clubhouses. There's guys that make massive investments in their communities. Like, for what we're buying, it wouldn't make financial sense to put in a clubhouse and a pool, but just that slightly larger investment to get a little bit better look shows that we at least it shows that there's at least an eye or an attention to detail, versus just the wood post with a light drilled onto the top of it because it was the Home Depot special of the week. It just gets it away from that mom and pop look a little bit faster.
I love it. And each community is different. Each market's different, what you could be able to do, and you have to be able to build to that, but you shouldn't be scared of investing a little bit more to get to that point.
Correct.
So, I mean, you've gone through how many parks do you own currently?
25, 24.
And you've bought over 30 parks in your career?
Yeah. And we have other stuff too, in addition to parks as well. Yeah.
So what makes you, and I know you're in industrial and self-storage, and I follow you on social media. What would make you walk away from a deal that, if you're walking into, what's something that's, hey, this is a red flag, comes up, Mario says, this is not for me?
Yeah, I think the biggest deal killers for us are going to be location. Can't change the location. You can change a lot of things, but you can't change the location. We're buying for 10 or more year holds. So we are very focused on the location because we're going to own it a long time. And I've got one community that I bought that not a huge fan of location. Surprisingly, the market, that neighborhood is actually changing in our favor right now, not because of anything that we did, but we've owned it probably 7 years, and it's the one property that I bought and I went, yeah, I might have jumped the gun on this one. It's just a very it's a rental area. Like, it's always going to have high turnover. People don't really want to own. Even if you sell them a home, they're probably going to walk and the next guy is going to come in and want to rent something. And so I would say the neighborhood is big. I'm much more cautious about that now than I was in the beginning. Flood zones are obviously a major risk. We have a couple of communities that have sections in flood zones, but we're not trying to buy things right on the water. Being in Florida, we have a pretty high concentration of properties in Florida, and so we're sensitive to that. I would say too, being too rural kind of goes back to location. A lot of people don't mind being in farm fields. I want to make sure that if we're buying something, there's a reason that people would want to live there. It doesn't mean that if there's a farm field next to it, we wouldn't buy it. But when you're out in the boonies, I'm just concerned about the long-term demand for that. And so we try and stay near major metros, even if we're not in the metro. We have to be close enough to where people are commuting in and out of town. So we don't own much in real rural areas, and also low rent areas are somewhat concerning. You get into an area where the market lot rent is in the threes, you're probably dealing with a pretty low income tenant base or resident base. And what we want to do is we want to offer the lowest cost home ownership option in a market. And if everybody's poor, there's a lot of affordable housing typically in the area. So we're looking for areas that have 450 or more lot rent potential is kind of what I would say, so that you start getting down into the lower lot rents too, your expense ratio starts to go up. Sure. Because the cost of a plumbing repair costs about the same in most places. The cost of insurance doesn't take into consideration your lot rent. So it does, and with your with a few factors in insurance, but you get the point. There's certain expenses that are going to be the same no matter where you're at. And so if you're capped on revenue, or you have a very low revenue cap, your expense ratio is just going to be high. And we like to stay away from those markets as well.
You mentioned that you sell the homes or people coming back renting them. Do you do rent to owns, or you try to sell everything through third party?
For the most part, everything is cash or third party bank financing. We do have a couple of communities that have some rentals, but I just look at rent to own as it's a rental, right? I mean, the chance that tenant is going to exercise their option at some point is pretty low. And doesn't mean we won't do it, but we don't do much seller financing. We don't do much on the lease to own options. I would say that if there's a reason that we don't want the homes, I would consider doing rentals, meaning like if there was a redevelopment play in the future, which we don't do much of that, then I can see keeping it as rentals. But like for that community that I mentioned that was in a location I'm not super excited about, we would sell the home for a relatively low purchase price. The older homes, we don't owe anything on them. We'd sell them for a relatively low price. And just for whatever reason, there's high turnover because people just are unstable. They're not stable. They have a renter mentality. Even if they write a sizable check, for whatever reason, that area is very transient. So, but a place like the Houston property, not an issue. You're not going to have that problem. They're very owner focused, and it's a very high income area to where they can either get the bank financing or they've got the cash and they're sticky.
Got it. So now when you're out and you're looking for these deals, are you out there raising money yourself? Are you using your own money? Like, how are you structuring these deals when you're acquiring them?
Yeah, we have a fund. For about 10 years, we syndicated and just did, independently sponsored each deal, new syndication, and it worked. We looked at the fund model 3 or 4 times, and every time we're like, I'm going to do that. It doesn't make any sense. We didn't want to be forced to, raise capital at a fast rate and then find a place to place it. We've seen seen others make the mistake of raising too much money too fast and then not having a place to place it. And so you end up buying things that you wouldn't normally buy just to get that capital to work. So we kind of avoided the fund model for a long time. And then once we figured out once I figured out what I wanted to be when I grew up, I decided that the big picture warranted bringing on a director of investor relations who's actually a partner as well, and raise at a much faster pace, which made sense to form a fund, and it's worked. So at this point, we have a Reg D 506C fund.
Okay. So, and now that's allowing you to go across all different asset bases. I know we've been talking just about MH, but what drew you into self-storage or to industrial? Because
I've actually owned self-storage as long as I've owned parks. I just don't really talk about it. We've never really built a marketing machine to go out and source self-storage deals. It's really been when a good self-storage deal came across my desk, more of a distressed or a real strong value add deal, similar seller profile to most of the mobile home parks we're buying, we'd buy it. And I don't manage any self-storage. I don't have the patience for that. But we like self-storage because you have variable rates, so you can keep up with inflation, short-term leases, very low turnover costs, quick evictions, things like that. You don't have the landlord-tenant laws that you have in the mobile home park space or in housing. And they are, I don't want to say they're not management intense, because they're marketing intense. But it's a good alternative asset for us, and they do well in recessions. Same thing with the industrial. We're mostly buying light industrial properties, small bay, nothing, not large credit tenants. They're really like large storage units for commercial tenants. And those are less management intense than the self-storage. You get longer term leases. There's not a lot of new supply coming online. That's the problem with storage. Self-storage, there was a lot of new development of that for quite a while. It's slowed down now. But on the mobile home park side, as you know, there's really no new development of any scale. And so your competition is pretty limited, similar with the smaller bay industrial properties. And RV parks we like as well, because you can fill them up quickly. And really long-term RV parks that function a lot more like a mobile home park or affordable housing. We're not in the resort side of things, or in the short term for the most part, but that does kind of fit in with the affordable housing piece. All four of those assets have one thing in common: consolidation, generally limited supply. Storage has changed, and even RV parks has changed a bit. And then also they perform well in recessions. And missing one, but you get the point.
You do see a lot of crossover in this space with those other subsectors. And we had a guest on recently, Jonathan Hayek, and he does industrial, like small bay industrial in multiple states. And the beauty of it is the people he's renting to, they're almost AI, impervious, right? They can't, those are business. You got an HVAC contractor, AI is not knocking them out of business, or a plumber who's been in business for 25 years. They're not going out of business. They just need a place to go to work.
Correct.
And to your point, they're not making small bay industrial throughout the country. They're making these large, industrial warehouses, but the small bays, there's such a limited supply, and there is an opportunity in that. And
they are cost prohibitive to build.
Yeah. And to your point on the self-storage, we bought 2 parks from a gentleman, local investor in town. He owned a pawn shop, PAWN. I know I have a bad accent, but just
pawn shop. Huh?
And he had self-storage. And I asked him, older gentleman, still talk to him. It's like, if you could do it all over again, what would you do different? He's like, I'd only do these. And he pointed to his garage, just because every time someone didn't pay, he just sold it in his pawn shop. And he said it was so simple to do.
Yeah.
We just, we're just narrowly focused in the MHP space, and that's where we've kind of
that's
stayed
been
in
our
lane.
focus too. I mean, that's the main thing for us that we put the marketing dollars behind, and really the acquisition team is only focused on mobile home parks. So, and we only manage mobile home parks, but we've kind of split off into other things over a long period of time. But yeah, if I were to go for one asset class out of all of them, if I could pick one, it'd be mobile home parks.
So what do you think is the biggest mistake that you see new operators, because you train new operators, you talk to a lot of new operators in the space. Like, what do you see as the number one mistake that new operators make as they're getting into, deciding they want to be a mobile home park investor or a mobile home park operator?
Yeah, I think there's several things. I mean, number one is they don't realize that it's a business. So there was this mental transition that I went through. Before I was in the mobile home park space or commercial real estate, I was flipping single family homes for many years. And before that, I was a real estate broker. And so going from the single family flipping business, that was a business. It was transactional, right? If source a widget, sell a widget. And that was basically that business. And then when I wanted to get into commercial, I started looking at apartment buildings. And for some reason in my head, I shifted to this investor mindset, right? And I'm like, well, now I'm going to be more of an investor for cash flow. And so I started looking on LoopNet and Crexy and all these different websites and networking with brokers and doing that whole thing, because in my mind, an investor just has a deal brought to them. They click and purchase. I mean, I'm kind of converting this to a stock or bond investment, which is extreme, but it was kind of like, I'm going to just buy cash flow streams, right? And I just need to talk to brokers and look at listings. And I got very frustrated after almost a year of not finding anything that really cash flowed, because I was looking in the wrong place and I was thinking too much like an investor. And I needed to put on my business owner hat and start thinking about, how do I create a lead flow system that generates deals for me, right? Off market deals that I control. How do I build out a property management team to run that? I'm not just going to, initially I was thinking, talk to brokers, get pocket listings or get listings, and buy them from them, and then hire a third-party property management company. They'll just manage everything for me, and it's just cash flow machine. Not reality. All right. So I ended up stumbling across a mobile home park in that period of time. And right around that time is kind of when I realized I need to create a marketing machine and that can produce off-market deal flow and build a business, really is what I'm getting at. I went from running a business for the home side to thinking I was an investor, but really I'm just in the business of real estate investing. So it's a mindset shift. You've got to build a business. Number two, I think people getting into this industry think that they are going to find a deal pretty fast. 3 months, 6 months, maybe. They're going to buy a park and then they're going to go buy 10 or 50 or 100 like Frank Rizzo, right? So I mean, they see Frank out there building this awesome portfolio, and then they get frustrated after 90 days or 6 months of like talking to a few brokers, and they don't realize that this is a slow game. It really is. You might look and say Frank's bought X number of parks this year, but he also has a pipeline and a business that's built up that momentum. And so people get in 60, 90, 120 days, they get frustrated and they burn out because it doesn't happen for them fast enough. Most people cannot make it in this business, either on the acquisition and investment side or the brokerage business. And the main reason, they just don't have enough runway. They just don't have enough runway of being consistent. You have to be consistent at this business for 6, 9, 12 months, in my personal opinion, to start getting deal flow, to actually close, right? Because they're slow transactions too. You tie it up and you're 90 days, 120 days in to close on a lot of these. People just they can't float themselves that long And then they buy the park. Here's the third thing. They buy the park and they think they're just going to live on cash flow. Well, when you're, yeah, maybe if you're buying stabilized, simple cash flowing parks, but most people who are getting into this are looking for value add deals, and they don't understand that they have to, there's a runway there then. So not only did they take a long time to buy that first deal, but then they have a year of minimal cash flow because they're turning around this property, bringing rents to market, doing all the CapEx stuff, all the things that we're talking about. So now you might be 2 years in before you're kicking in some really good cash flow on that deal. Most people just can't make it that long. They just, they burn out too fast.
And they forget how or they don't realize. It's not even they forget. They don't realize how operationally intense it is.
They thought it was an investment. It's a business.
Where they think that just because people own their homes, like you don't have to do anything for them. And
you're just renting dirt, right, Frank?
Yeah, just renting dirt, right? What do I have to do?
Right.
But even at that, there's always things that you as an owner or a manager get called into, and you have to be able. We're not in the. I tell people all the time, we're not in the bricks and sticks business. We're in the people business,
Sure.
right? So we're managing people's emotions when they're at their park. If they have a problem, if somebody's driving by their home and they work from home and somebody drives and the music's too loud, your office is going to hear about it, right? And it's how do you resolve that issue and deal with that person and that emotion, because that's the most important thing that's happening to them during that day. And even though you're just renting the dirt, you're still you're intensely involved in their lives. And I think people don't understand or realize that. And I think the faster they get it, the better they'll be. And I think that's one of those challenges that new people face all the time.
You see that actually quite often. People will buy their first park and they'll buy a low occupancy, 50% occupied, piece of crap park that just needs everything. And they didn't get into it right, number one. But number two, they underestimated the work. And then they're stuck with one park for 3 years. And they're like, this thing is just a beast. I never expected it was going to be like this. And it begins to own them because they took on that's the fourth thing, is they take on too big of a project for what they can handle. I tell newer mobile home park investors, don't take on heavy infill projects. I'm not even taking on heavy infill projects because I know that it's going to take my team away from buying the next deal and being able to, I'd recommend doing light value add deals, not heavy infill or heavy lease up type things where you're taking on a lot of risk. And they can kind of get in over their head on that first deal because they bought a cheap park, right? They said, I've got $100,000 in the bank. What can I afford? So they go try and buy things based on what they can afford. And I'd rather buy a very expensive park, a large expensive park that has light value add opportunity that I can control that and actually implement that business plan in 1 to 2 years and be stabilized and have it be boring in 1 to 2 years, than take on a deal that I can triple the value on, but it takes me 5 years to do it with a lot of risk of not actually being able to execute that business plan. So taking on too much. And then I'd say not doing thorough due diligence and not educating themselves. It's funny how many people, I have an education business that teaches people how to buy mobile home parks. And there are some people that come to us and go, oh yeah, that's too big of an investment to learn how to do this and have someone like looking over their shoulder to do it. I'm like, so you're going to go and buy multi-million-dollar assets to become a multi-millionaire over the next several years, but that small investment is holding you up. That's less than an earnest money deposit on your first park, right? And so I think and this is not a pitch, it's just get educated, understand that you're stepping into a new business and you need to understand the systems and the thorough due diligence process to make sure that you're not buying a bad asset, which can wipe you out and, put you into bankruptcy, literally, if you buy the wrong deal. So just understand what you're getting into. Don't wing it. You can't learn it over YouTube. You can't learn it over Facebook or Instagram Reels. It's just too much, but you have to get the college education from somebody who's done it so you don't blow yourself up on your first $1 million deal.
I think you hit the nail on the head. It's you have to have the right people in place. And you talk about, especially the first time where you might feel like you're paying up a little bit, but that ties
Sure.
into what you said before about paying up a little bit more for the person that you have to hire on your team and getting the right person on your team rather than just having a warm body. You pay up for the person, maybe you pay up for the real estate to get especially in the beginning when you don't know what you don't know and you're going to be
Sure.
learning essentially on the fly. And then even if it's paying up for the education, having the right partner to walk you through that first deal, that second deal, that third deal, it will pay off immensely because
Yes.
you're I mean, I'm still learning every day. I've been doing this for
Me
12
too.
years and I'm always looking at something where you want to push your limit and be like, all right, now I'm learning something new. Now let me take this back and let's compartmentalize it and take it on the next time. But there's so much to learn and this business is changing so
Forever.
fast. Like so many things are changing in how counties are looking at mobile home parks and what's happening, how they're viewing the utilities and the setups and what their expectations. Like you need to have the people in the trenches with you who has done it so they can kind of guide you that right way. And I know that you've been very open with your time and your ability to help other people too, which is great. So Mario,
I love that part. I mean, I enjoy teaching people and working with people. It's fun. I like seeing people grow in their personal, lifestyle and what they're trying to accomplish. Yeah.
so what's the power move this year for the rest of the year for Mario Dattilo and your team?
Yeah. So power move for us is I've got we're building out multiple portfolios with JV partners. And so I for me personally is to add on one additional portfolio by the end of this year. We've had two new ones added already this year. We're already on track to exceed what we did in acquisitions last year. So it's not so worried about the acquisitions. We're on a pretty good pace. It's building relationships with other guys, mostly that have at least a few parks under their belt, but they're getting to that point where they're out of money and they just want to focus on buying more deals and being able to scale their portfolio and not going out and starting a fund or getting into the fundraising business. And so more JV deals like that, being able to come alongside them, help them improve their business systems and deploy capital into their deals so they can focus on growing their portfolio. So yeah, that's really where I'm personally focused. We have my education companies growing. We got some targets there. But really that's just a mechanism for more partnerships, right? Like we're partnering with more people through that. So ultimately it's just more at least lightly experienced park owners wanting to grow their portfolio and us coming alongside them to help them do that.
So if you're a park owner out there that's listening and they wanted to reach out to you, how would they find you?
Yeah, I mean, if they're equitygrowth.net is a simple website to go to. If you're looking to learn, I know most people listening to this probably are already in the business, but if they're looking to learn how to invest in mobile home parks, they could go to getrealcashflow.com. And I mean, like you, all over social media, just making a lot of noise and pissing people off and annoying them with all of the different content. So not very difficult to find on any of the platforms, but would love to help people. And I think what you've got going on here is awesome. Your podcast is great. And so, and your show,
No.
I love what you're doing. It's great because it's entertainment, but educational as well.
I appreciate that. We did that because we have so many people who from here that were, been involved with us and we'd come back and we tell them stories and they don't get it or they wouldn't believe it. And then when we go down and this was just the easiest way of sharing, what's really happening down on the ground, and for us, I'm sure your story is pretty similar. I mean, we started this, bought my first park 12 years ago. 10 years ago, it's kind of friends and family and trying to get people involved. And then it just by word of mouth, it grew. But when it's 7 people, it's easy to call, let them know what everything's going on. And as that tree grows, it's tough to reach everybody the way you want to, but it's easy to say, hey, I didn't get a chance to see you or speak to you, but here, take a look. This is what's happened. And the beauty of Trailer Park Turnaround is that we don't script any of it. It just happens organically. It's what happens on the ground. And then we just take it and, we send it out. So it's a little, I mean, we do edit, to make sure it looks nice, but I mean, it's all unscripted and real, like
It's
true,
the real Trailer Park Boys.
real things of what happens out at the trailer park. But
Yeah.
Mario, this has been a great conversation. I love talking with other operators and doing deep dives right into what it takes to make things work. You've obviously shown everybody what it takes to make things work by getting into 7 states now. I'll update that information. And if you're out there, you found value in this episode, then like it, share it on the platform, and give us a rating on the platform you're listening to, because that's how we get to more people and we can share the message of investing in mobile home parks, what it takes to be a good operator, and getting into the right mindset. So thanks for listening, everybody. Mario, thanks for being a guest. And until
Thanks
next
for having
time,
me.
happy investing.